History proves markets often rally the moment the first missiles fly, but are you prepared for the statistical mirage hiding over 1 million lost full-time jobs?
Former Fed Chair Joseph Wang and resource legend Rick Rule lead our panel of experts today, exposing the massive disconnect between government headlines and economic reality.
We have used advanced AI to distill over 5 hours of deep dive analysis into this high-impact briefing, saving you precious time while delivering the alpha you need.
Stick around to see why Rick Rule is exiting silver and which 10 major cities are facing a total housing price collapse by 2026.
Today is February 28th, 2026, and the world is reacting to a massive escalation in the Middle East.
Joseph Wang reports that the United States and Israel have begun an assault on Iran, aiming for regime change.
Wait, so we're talking about a full-scale war breaking out right now?
Exactly. While the president released an 8-minute video justifying the move, Joseph Wang notes that the fighting is ongoing and highly unpredictable. Despite the initial panic, Joseph Wang argues that investors should look at history, specifically the 1990 Gulf War and the 2003 Iraq invasion.
In both cases, markets sold off during the military buildup, but rallied furiously the moment the actual strikes commenced.
So you are saying this might be a sell the news event for oil and a buy the news for stocks?
That has been the historical pattern. Wang suggests that these geopolitical events are usually something you want to fade rather than follow.
Joseph Wang points out that Iran is much larger in both geography and population compared to Iraq in the past.
They also possess hypersonic ballistic missiles that are difficult to intercept, and they may have support from Russia and China.
Because of this, the war might last weeks rather than days, potentially leading to significant casualties.
Beyond the war, there is a viral piece by Centruni about AI displacing white-collar workers.
Wasn't there a recent example with Jack Dorsey?
Yes, Jack Dorsey of Block recently fired 4,000 out of 10,000 employees, suggesting AI has made many roles unnecessary.
Joseph explains that while technology makes society wealthier, it often pushes specific cohorts out of the labor force entirely.
So they aren't unemployed because they just stopped looking for work?
Exactly. We saw this with manufacturing, and we might see it again with white-collar workers tumbling into lower-wage blue-collar jobs. On the political front, Joseph Wang predicts the Republicans will lose the House in the midterms.
The anti-war constituency in the party feels betrayed, which could also hurt J.D. Vance's prospects in the 2028 election.
Wang believes that AI will lead to structurally lower demand for labor, creating a bumpy economic road.
As a result, he expects the policy reaction will be more rate cuts to combat the resulting deflationary pressures.
Finally, keep an eye on private credit and debt markets.
Joseph notes that disruption is already creeping into software-heavy credit funds, which are taking haircuts on equity prices.
So watch the war news for the short term, but watch the debt markets for the long-term AI impact.
That is the plan. It is going to be a volatile few weeks. Welcome back as we dive into Rick Rule's latest insights from his conversation with David Lin.
Rick recently made a prescient call on a 30% silver correction, and he is explaining why he exited half of his physical silver position.
He mentioned buying silver at $20 and watching it hit a parabolic peak before he decided to take profits.
Exactly. He moved that capital into high-quality silver stocks and physical gold, which he treats as a savings asset rather than a speculation. The core of Rick's thesis is the inevitable deterioration of paper money.
He expects a 75% drop in purchasing power over the next 10 years for major Western currencies.
That is a staggering decline. How does he recommend preparing for that?
He suggests that investors must move into productive resources and hard assets like gold to shield their wealth from what he calls government theft through taxation and inflation. In the uranium space, Rick points to a major supply crunch that many are overlooking.
He notes that the Sprott Physical Uranium Trust now owns 82 million pounds of the estimated 200 million pounds of above-ground inventory.
And since that uranium is not for sale, it means the actual available buffer for utilities is much smaller than people think.
Precisely. Rick believes this makes a uranium price spike a mathematical certainty as production deficits persist. Rick highlighted a massive $4.2 billion deal between BHP and Wheaton Precious Metals.
BHP sold a silver stream from the Antamina mine to raise capital for massive upcoming construction budgets.
Why would a giant like BHP do that instead of just using their own cash flow?
Because the market values precious metals cash flow at a much higher premium, giving the streaming companies a permanently lower cost of capital. For retail investors, Rick has a blunt piece of advice. Stick to the big players.
He argues that unless you are willing to spend 40 hours a week reading annual reports, you should buy the producers, or the beta.
So the alpha of junior miners is too risky for the average person.
He says the probability of getting a return in juniors without doing the work is essentially zero. Rick is warning that the oil market is currently a news trade driven by Middle East tensions.
If the Strait of Hormuz is blocked, the 20 million barrels of export crude moving through it daily would be cut off.
He said the quote would go crazy in that scenario, right?
Yes, although he notes the Iranians lack the physical capability to maintain a blockade long term, the initial shock would be tremendous. Looking further out, Rick sees two distinct bull markets emerging over the next 10 years.
The first is in precious metals like gold, driven by the debasement of the currency.
And the second,
in industrial materials and base metals, which he says have suffered from 3 decades of chronic underinvestment. Rick's final takeaway is for investors to be honest with themselves about why they own an asset.
He even offers to personally rank natural resource portfolios for free on his website from 1 to 10.
that is a great deal. Just no crypto or pot stocks, as he says.
Right, he sticks to what he knows best, resources and the arithmetic of economics. The geopolitical landscape has shifted dramatically following a joint US and Israeli strike on Iran. This was not just a military operation, it was a targeted decapitation strike against the top of the Iranian government.
Exactly. Ryan Bohl from RAIN explains that unlike previous strikes in June 2025, this mission was deeply coordinated between the two nations to knock out command and control from the start.
So we are no longer talking about shadow wars or proxies. Is this now a direct war between the US, Israel, and Iran?
That is the core assessment. Adam Taggart notes that the hope of avoiding a full-out kinetic situation has evaporated. Ryan Bohl points out that the geography of the war has expanded, with Iran striking targets across the entire region.
A stunning development is the confirmed death of Ayatollah Ali Khamenei and the head of the IRGC. However, Ryan Bohl warns that Iran's system is ideologically structured to survive top-down assassinations.
Does that mean the government has not collapsed yet?
Not yet. Command and control remains functional. The IRGC is still firing missiles and issuing orders, showing a resiliency built into their framework.
Iran's response has been broad, striking every single Gulf Cooperation Council country. We have seen footage of interceptions over civilian areas like Dubai and Doha.
Yes, CENTCOM confirmed that 3 U.S. soldiers were killed and 5 were wounded, likely from drone or missile attacks in the Gulf region.
Military experts believe the Allies are close to total air superiority. While Iran has thousands of ballistic missiles, their air defense systems were decimated in the first 900 strikes.
The worst-case scenario involves a sustained supply interruption. Ryan Bohl mentions that Iran could declare war on energy, targeting refineries to trigger a global recession.
Bohl thinks a full scorched earth is unlikely now, but we should expect a price squeeze and market volatility through temporary interruptions and speculative gouging.
Looking ahead, there is a slim chance for an Iranian Gorbachev. If the reformist ranks gain credibility, Iran could eventually move toward a more democratic, less confrontational path.
However, that is a medium-term view. In the near term, we are more likely to see a regime that hunkers down and doubles down on its hardline ideology.
How should investors be looking at this?
Ryan Bohl suggests watching the sovereign wealth funds of the Gulf. If they have to spend billions on domestic reconstruction and subsidies, their appetite for Western investments like tech and AI could diminish.
Despite the panic, Bohl reassures us that this is not the start of World War III. Neither Russia nor China has a mutual defense treaty with Iran, and they have little incentive to risk everything for a regional partner.
Today we're dissecting Jeff Snider's latest bomb drop. The U.S. has actually lost 1.5 million full-time jobs over the last few months.
Jeff Snider's data shows while headlines scream strong growth, the engine room of the economy is actually catching fire.
Wait, 1.5 million? If everyone is losing full-time jobs, why does my news app say unemployment is still low?
That's the trap Jeff Snider is exposing. We're swapping careers for side hustles and part-time gigs just to survive.
Jeff Snider argues that the establishment survey is flat out lying to us compared to the household survey.
Exactly. There's a 1.8 million job gap between the two, and Jeff Snider believes the household data is the real truth.
Hold on. 1.8 million jobs just vanished in a rounding error. How is that even possible?
It's because the government's favorite chart counts jobs, but Jeff Snider's preferred chart counts actual people. Big difference. Jeff Snider points out that we are seeing a massive shift. Full-time positions are cratering while part-time work is exploding.
It's the classic recession playbook. Employers stop hiring the 40-plus hour crowd and start leaning on temp labor.
So people aren't working, they're just working more jobs to make the same amount of money.
Precisely. Jeff Snider calls this a clear sign of economic contraction, despite what the White House says. Jeff Snider also highlights the birth-death model, which adds about 140,000 jobs a month based on assumptions.
Wait, assumptions? You mean they're just guessing how many new businesses are being born?
Pretty much. Jeff Snider argues these assumed jobs don't actually exist in a cooling economy.
Right. It's a formula designed for growth years, but Jeff Snider says it's failing miserably right now.
One of Jeff Snider's biggest red flags is the decline in average weekly hours, now sitting around 34.3.
34.3 hours. That doesn't sound like a full work week to me.
It isn't. Jeff Snider warns that when hours drop, layoffs are usually only a few months away.
It's the last step before companies start handing out pink slips. First they cut overtime, then they cut people. Jeff Snider predicts a massive catch-up where unemployment spikes above 4.5% as data is revised.
History shows the first draft of jobs data is always too optimistic during a downturn. Jeff Snider expects an ugly wake-up call.
So we're just waiting for the government to admit that things are actually bad.
Exactly. Jeff Snider says by the time the data looks bad, we'll already be deep in the recession.
Jeff Snider's analysis suggests we could see the first official negative payroll month by late 2024.
Negative, as in, the economy actually lost jobs instead of just growing slowly.
That's the prediction. Jeff Snider believes the underlying eurodollar tightening is finally choking out the labor market.
Once that happens, there's no hiding the recession anymore. The statistical mirage will evaporate.
So, the big takeaway from Jeff Snider is to ignore the flashy payroll number and look at the household survey instead.
If you see the household number continuing to diverge or drop, that's your signal to get defensive with your money.
Okay, so household survey equals real people, payrolls equals corporate math. Got it.
Precisely. Jeff Snider's research is the map you need to navigate this statistical minefield. Nick Gerli from Reventure Consulting has released a list of the top 10 cities where home prices are expected to decline in 2026.
He notes that many of these markets are already seeing values go down due to elevated inventory and higher days on market.
Wait, so is this happening everywhere or just in specific hotspots?
It is concentrated in specific regions, particularly the Sunbelt and Florida, where the pandemic-era boom is finally cooling off.
Nick's core thesis is that the market is shifting because inventory is hitting 10-year highs while buyer demand has plummeted.
So sellers are being forced to cut prices just to get people to look at their listings.
Exactly. In cities like Orlando, inventory is at a 10-year high, and demand is down over 35% from its peak.
When you have that much supply and so little demand, price cuts are the inevitable result.
Florida is going through the biggest downturn in the U.S. right now. Migration into the state has plummeted 90% from the pandemic peak.
Between rising property taxes and insurance costs, local buyers are simply priced out of the market.
A 90% drop in migration. That sounds like a complete reversal of the trend we saw in 2020.
Look at Austin. Prices are already down 24% from their peak in June 2022.
This big decline is actually a good thing for buyers, as it brings values back to where they were in 2021 and closer to actual income levels.
So Austin might actually become affordable again soon.
Denver is another market to watch because rents are in free fall. New lease rents were down 18% in the fourth quarter of 2025.
When rents drop that significantly, it often spills over into home prices, which are already down over 3% year over year in Denver.
The number one market on the list is Colorado Springs. Nick predicts home values will drop 7.5% in 2026.
That is the highest downward forecast for any large metro in the country right now.
Why Colorado Springs specifically?
The metrics on inventory and price cuts suggest it is currently in the middle of a heavy correction.
Nashville is also facing headwinds. While the overall metro might drop 4.1%, the city center could see declines between 5 and 8.3%.
It remains one of the more overvalued markets, entering 2026 at 19% overvaluation. Ultimately, Nick views these downturns as a positive for buyers. Rising inventory means you finally have negotiating leverage.
He recommends using tools like the Reventure app to track months of supply and price cut percentages in your specific zip code.
So the goal is to wait for the bottom and negotiate for those big discounts.
Exactly. Don't be afraid of the crash. Use the data to find the best entry point. To kick things off, Nick Gerli argues that the current housing prices are buoyed by a massive imbalance between supply and demand.
Exactly. He points out that while demand has softened slightly, the supply side is struggling to keep up, keeping prices high.
So if I get this right, it's like a tug of war where one side can't let go of the rope.
Exactly. Nick's worried that if the demand truly drops or if supply increases, we could see a steep downward adjustment.
Next up, Jeff Snider, with his take on what he calls the statistical mirage affecting our perception of the job market.
Right. Jeff highlights how the reported job numbers could be masking deeper economic issues, including underemployment and declining participation rates.
Wait, so basically it's like the economy's putting on a happy face, but is actually struggling behind the scenes.
Exactly. This can lead to misguided policies if we assume everything's okay based on surface data.
Finally, Rick Rule emphasizes that we should brace for a long-term trend of currency debasement.
His argument revolves around government policies that are likely to lead to inflation and erosion of currency value over the next decade.
So you're telling me my dollar could be worth significantly less in 10 years? That's a scary thought.
Absolutely. Rick's message is clear. Diversifying and protecting assets is crucial in this environment.
Here's a notable point. Despite their differing focuses, all three agree on one thing. The current economic landscape is very volatile.
Indeed. Each guest suggests that investors need to stay vigilant and adaptable.
So basically, it's a jungle out there, and we need to be prepared for anything.
Exactly. This volatility isn't just a buzzword, it's a call to action for proactive risk management.
Both Nick and Rick also stress that diversification is more crucial than ever.
Yes, Nick highlights real estate specifically as both an opportunity and a risk, while Rick warns about the dangers of holding too much cash.
So if I'm hearing you right, these two are saying, don't put all your eggs in one basket. Especially right now.
Exactly. As markets can swing wildly, a well-diversified portfolio is key.
Now let's talk about where there's tension. Nick thinks the housing market's correction is imminent.
In contrast, Rick believes we're in for years of inflation and debasement that will keep prices high across the board.
Wait, so one sees a quick fix while the other talks about a decade-long headache? That's a major difference.
Exactly. Nick sees signs that could trigger a faster adjustment, while Rick's case hinges on systemic issues with currency.
Then we have a philosophical divide. Jeff is quite skeptical about the reliability of economic statistics.
On the other hand, both Nick and Rick believe that while flawed, these indicators can still provide some useful insights.
So we have one guy saying don't trust the numbers, and the other two saying they're not perfect, but they matter.
Exactly. It's a classic debate about data interpretation.
If you found these perspectives insightful, give us a thumbs up and subscribe for more expert analysis.
We compile the most critical insights so you can navigate the markets with confidence.
Seriously, this discussion saved me hours of research. I'm subscribing right now.
Thanks for tuning in, and we'll see you in the next video where we'll dive deeper into what these insights mean for you.